Landis+Gyr, headquartered in Switzerland, is the leading global provider of integrated energy management solutions for the utility sector, namely for the foundation of a smarter grid, including smart metering, grid edge intelligence, and smart infrastructure. Its products meter electricity, water, and heat for energy utilities around the world. So hopefully we'll have Peter with us in a second today virtually. A longstanding board member, Peter took over as CEO in November 2024, having served as CEO of Census earlier in his career when it was acquired by Xylem. Landis has 29 million shares, trading recently at about 51 Swiss francs, or about a $58 US stock price, 1.65 billion market value, 220 million net debt for 1.87 billion enterprise value. So we'll be conducting a virtual fireside chat with Landis today. All right. Well, thank you for joining us. I introduced you already, so we'll hop right into our discussion. So for starters, Peter, you've recently assumed the CEO role at Landis+Gyr. It's been a challenging year, I think, for the stock. I think the long-term vision remains intact. So, help us help investors here understand kind of the long-term investment case for Landis, looking out over the next few years, and what you and the team are doing to position the company strategically and structurally for success.
Happy to do that. And first, thank you for having me. And a bit of level setting when we talk about Landis+Gyr. We have 130 years of history, Swiss-based company, about $2 billion in revenue, and we are the leader in electric smart grid metering. You talked about the last couple of months or the last year being challenging. I would probably more use the term interesting. And for me personally, I think I've just passed the 100-day mark, so it's still interesting with enjoying and having fun with the team every day. But more importantly, let's focus a bit on where we believe the value creation is, and that has not changed from an announcement we made back in October on our focus and where we believe the strategic pillars are for our value creation. And it really starts with our focus on our North American business. We are a leader in the North American business, and we see the greatest opportunities for our business here in North America. Built an exceptional business model around different elements of the value chain for utilities, and we're exceptionally well positioned with them and being part of the critical infrastructure for the utilities. Financially, this is also the geography where we have EBITDA margins that are substantially above what we see in the rest of the business and the overall EBITDA margins for the business. And then, last but not least, that means that our return on capital is the best in North America, versus the other two geographic segments we have, being in EMEA and being in Asia Pacific. And that brings me to the second strategic initiative. We announced that we are reviewing what we're doing with our business in EMEA. That's 40% of our business today. That's about $600 million of revenue. And we have announced that we're going to revisit and review options for that business going forward. And we have been over the past, you could actually say decade, we have adjusted the structure, revised and refocused the manufacturing footprint, and continue to optimizing it. But it does not deliver the same EBITDA margins the way the business is set up in Europe for the industry as in Americas. And we're trying to shortly address what the outcome is of our strategic review. And then the third element is we're also evaluating a listing in the US for the company stock. I mentioned before, for the past 5 years, going on 6 years now, we've been listed on the Swiss stock exchange. And as we are realigning our business around our North American market, we want to also align the capital markets with where our business is. And even today, already 80% of our EBITDA for Landis+Gyr is made in North America. And we're certainly attracted by the liquidity that exists in the US market versus a much smaller market over in Europe. So we continue to believe that we have a highly attractive business in North America, and we want to focus talent and capital allocation on the North American market. So this is really the three initiatives that we're focusing on. And the business.
Great, thanks. Two follow-up questions there, I guess. First off, could you provide a little bit of clarity as to why you think the North American market is structurally superior to EMEA? I mean, is it the nature of the competition? Is it the, diverse countries and regulations that you have to tend to in Europe? Just a little clarity there.
Yeah, I can provide a bit of clarity there. You touched on some of them, but I think the most important one in the US, we've been able to establish a business model that allows us to participate in various elements of the value chain for a utility. So we are delivering the devices and the infrastructure to them. We operate on a recurring revenue stream, some of the infrastructure elements over a 10 to 15-year period of time. And back in the utilities, we're also embedded with critical software applications that utilities utilize that, again, delivers a recurring revenue stream for us and embeds us. Over in Europe, we have not been able to replicate the business model. We are much more a device-centric overall business model over in Europe. And you also touched on one important aspect. Anytime we talk about Europe, we're already misleading everyone. It's really country by country specific. It's not a cohesive market, and France does something different from the UK. Germany does nothing. So very different structure. But and that's not just Landis+Gyr as an industry, we try to break out and participate in various elements of the value chain in Europe as well. And we have not succeeded. So that's the business model. And then certainly as we think about North America, really after 15 years of no growth in electricity demand, we see electricity demand growth returning to the US, sustainable growth that we are just starting to see, and that bodes extremely well for growth of our business going forward.
Yes, for sure. And I'd love to just dig in a bit on that. So, electricity demand is increasing in North America. I think there's a perception that may be a little bit incorrect that, the companies serving the smart grid may not participate as fully, just given the data centers are kind of in their own local geographies, and that may not propagate as much to the kind of smart grid in residential and kind of local commercial settings. But I think you would present perhaps a different argument there. So help us understand the types of, upside that you will see from load growth in the US, even if it's largely data center driven.
Well, I think data center, in a way, for us, it's indirect part of the growth. Again, in our business model, our customers are utilities, regulated utilities, and they have to deal with the demand growth. And demand growth is driven by multiple elements that we see. Obviously, AI and data centers play into that growth, creating demand growth for electric utilities, but it is just one element of the growth. We also see electricity as being the energy of choice. It's really electrons replacing molecules. We also see onshoring of manufacturing, driver for demand, and we continue to see population growth as well. So there's a multitude of drivers that we see that contribute to sustainable growth in demand for the next decades to come. And that growth really requires flexibility, requires efficiency in the grid, and that's really where we play. So there's a lot of capital expenditures required to facilitate that growth, but we are the flexibility, we are the efficiency element around technology that exists today. So that's why we see the demand being the driver for the growth we see in the market, and data center being a small part playing into that.
Got it. One more question on your opening strategic imperative. So help us understand the process and the timeline to potentially exit your EMEA business. I know that you mentioned that you are shutting down your EV business, which is Europe-centric, to, I think, help preface an exit of EMEA. But what is the sort of timeline for this? What is the timeline for a potential U.S. listing?
So on the EMEA business, again, we made the announcement back in October that we are reviewing options for that business. We've also been very open that we have also enlisted a bank for one of those options. And if you saw some of the announcements that we made, in particular, you referred to electric vehicle charging, which is probably the first concrete step in reviewing our setup in EMEA. We entered electric vehicle charging 4 years ago. European-centric hardware business on the belief that utilities will play a substantial role in utilizing EV charging across Europe. Now looking back, that clearly did not happen strategically. And then on top with some of the slowdown in EV that we saw in Europe, crowding of competition, that really led us to the decision to wind down that business. We absolutely believe EV charging will come back, but it's not for us to wait out our core customer base and our core competencies around utilities. So we exited this business. We are winding down that business. And then obviously in parallel, that helped us to create a much more attractive parameter around our EMEA business as we go down various paths. And concretely with EV charging, very beneficial for us as well. We articulated that turned into a loss-making business. We've been losing close to $1 million a month into that business. So stopping that EBITDA drag, and in addition, creating a more attractive parameter around EMEA. The process, it's a $600 million blue chip business in Europe. I would probably say we're running as fast as one can, with having an advisors, sell-side advisors in place. We certainly want to go back to this crowd and articulate something during 25. What is the outcome of those various options that we are reviewing? So that's for EMEA. You also asked about the listing. Another initiative that requires a lot of outside advice and focus as well. While listed in Switzerland, we already have US GAAP accounts, so there are some elements are in place, but we're working through that, and we're working towards a date that we have articulated in 26. I think there's a mid-26 is a realistic, ambitious time frame that we have articulated multiple times for working towards that.
All right, I think I saw a question in the audience. If we could have a mic up here.
Thank you. I'm not that familiar with your business. When you are monitoring for utilities, is that done on the distribution side? Could you give us a little better feel for what you're actually monitoring and who your direct competition is?
So, okay. So I sort of spend a bit more time explaining who we are in Landis+Gyr. So the devices that we've been producing for 100 years, it started out as metering. That was our core. And today, that is still one of the core capabilities of the devices that we offer today. They're probably more called grid edge sensors today than meters, what was the name in the past. And so this is really how we interact with the utilities and the attractiveness of where we sit. It's really the grid edge for the utility, the last element of their infrastructure. And on the other side is the individual consumer. So it's an attractive. So that's what we offer, and that's how we participate in the demand growth and enabling utilities to offer flexibility and resilience in the grid. If that was helpful to put us in the right perspective, what we do.
If there are no other questions from the audience, I will resume. Would you like to follow up?
Yeah, perhaps you could expand a little bit more on it. So we have public companies in the U.S. like ESCO that owns Doble. They are direct with the consumer. I'm assuming that is not a space you're in. And again, could you speak to who your direct competition is?
So other companies in the space in the US, that would be a listed company called Itron. In some segment, it would be a company called Xylem playing in some areas of the space. Europe also, Elster is a company that is part of Honeywell that is in that space, and a substantial number across the world of players that are different from the US players that play in Europe and in Asia Pacific. But since we're in the US today, those are probably the names you're the most familiar with.
And just one more follow-up. Are you the market leader within that, or are you mentioned 3 or 4 competitors. Where are you in the competitive space?
So globally and here in the US, we are the leader in electric metering. As we are focused on electric utilities as our customer base, we are the global leader and we are the leader here in the US.
So I'll pick up. I guess the markets were a little taken by surprise by the recent pre-announcement for the March fiscal year, which kind of downgraded your sales and to a lesser extent margin views. And maybe just for the sake of the audience and investors here who are somewhat new to the story, if you could help us understand, the disconnect between a very strong and healthy multi-year backlog, which I think you expect to continue to grow, versus having to take down the sales view for the fiscal year ending in March so materially. Like, just help us juxtapose those two dynamics for the sake of investors and understanding the business.
So as articulated the business model before in the US, utilities give us multi-year contracts running from 10 to 15 years to provide our service to them over that period of time. So that includes devices, software and services, and software revenue over that period of time. So if you think of our backlog, and we continuously have in the US backlog north of $3 billion, there is about 55% of our backlog is this software and service backlog that has a tenure of 8 to 10 years over the life of those contracts. That's one element of the backlog. So extremely predictable, week in, week out. We invoice those devices, we invoice for those revenue streams, and they are recurring and a substantial value standalone. The other part is the hardware-centric part of our backlog, which is the devices that we talked about, also some infrastructure element that probably has much more, I would say, on average, a 3-year horizon on how those devices are deployed in the field. I think we have seen that backlog be fairly stable over the last, I would say, 18 months or so, or maybe 2 or 3% up, which is consistent a bit with the growth that we've seen overall if we exclude any one-offs that we had experienced by the supply chain or pent-up demand. Coming back to the difficult message that we had to deliver around outlook, and it really comes down to the outlook that we articulated for 24. It's really, though it's called for our fiscal 24 year ending March, it's really call it a 7-week forecast that we have provided. Very, very forensically looking into every contract, every shipment that we can make before the end of the year. And there was probably at the beginning of the year an ambition level in our forecast and our view for the year that was not reflected in what I was able to find and what we can do in a 7-week period of time. As I mentioned before, I've just passed the 100-day mark. But in parallel, also, nothing has changed in looking at our pipeline, looking in our book-to-bill ratio. I think we have articulated multiple times that we're quite positive on having a nice book-to-bill ratio as we end the year. And certainly everything, if we go further down the road than end of March of our fiscal year, as we look at the pipeline and the prospects, nothing has changed for us how we view the market.
That clarity is quite helpful. One silver lining, I guess, in the pre-announcement, one could say, is that you're taking, inventory obsolescence charge on some older metering products because your new Revelo networked meter is experiencing faster than expected adoption. I think, Revelo has been a multi-year, success as a smart meter. So just help us understand, how Landis is winning with the Revelo meter and how that, sets the stage for future growth in the smart grid.
So Revelo is really our brand name for what is today referred to as grid edge sensor. And our first contract that put grid edge sensor on the map was for a utility up in the Northeast called National Grid. I think that's about 3 years ago now. the largest awarded contract in the history of our industry to date, I think north of 800 million. And that was a first scale adoption of acknowledging that grid edge sensors or Revelo is actually a requirement for the path forward as we see the growth in electricity demand. So they decided to go exclusively with us, 5.5 million meters, just that utility alone. So that really put grid edge for us and for the industry on the map. And since that, we have seen adoption across multiple utilities. And certainly when we launched the product and as we start to deploy it at scale, there was initially a belief that there will be a parallel path with the product version from before. But every utility segment, from investor-owned utility, municipality to co-op-owned segment, they really embraced the offering of the Revelo. So while we for a while thought that we have to offer both technologies, very quickly it became clear we can harmonize and focus on Revelo. And obviously that's something that we really liked, and it helps us drive the cost down. Volume is the number one cost driver for a new electronic product. So we really like that. Difficult decision to write off an inventory, but at the end of the day, it's a validation for us on the path that we've embarked on and helping us to create a cost base 25 and 26 forward for the product of choice across the utility industry today.
Your primary competitor reported a few days ago, and they had very strong performance in the part of their business they call outcomes in terms of sales and margins. What is Landis doing to kind of transition from its strength of the Revelo sensor or networked meter to help build out an outcomes business, which might be kind of the next arena for growth? I know you have a meaningful service and software exposure, but how do you kind of help build out the outcomes business to perhaps benefit from some of the trends that Itron is benefiting from?
A couple of things let me articulate here. I think if you go back a bit in the history of Landis+Gyr, about 15 years ago, we made an acquisition of a large company here in the US that was exclusively in the software business, and a bit of service business as well. So it's not something that we just discovered 5 years. It's been part of the foundation here in the US for us. And even today, we articulate in the US and the business model that are articulated, 32% today of our revenue in the US is around software, is around services, is a recurring revenue stream that we have utilities today. So I think we have a percentage here that is leading in the industry, and that one is quite exciting. And again, we talked about the grid edge sensor, our Revelo. We firmly believe that will enable business models above and beyond that we have today in our software and service revenue, simply with the complexity those devices have and the assistance and the help that utilities need in that aspect. So I think we're exceptionally well positioned, and we are breaking out our profitability already today by segment. In the US, we're consistently in the, I would say, 18 to 20% EBITDA range. So our business model with the software and service revenue stream allows us to be in 18 to 20% profitability, which again, I believe is the leading profitability in the industry.
Maybe just turning to some of the macro dynamics as it relates to potential tariff dynamics or other regulatory headwinds or tailwinds. As you begin to recover beyond this fiscal year in terms of margins, as your sales growth hopefully resumes and you move beyond this inventory obsolescence charge, what types of challenges are you anticipating in having to work around from a potential tariff or regulatory point of view?
So look, I think the tariff situation is the same as for everyone else, and it's a bit in flux every day. I think what helps a bit to understand the devices we talk about, to think of them, it's really think of a high-end laptop with an AI processor that is installed at the size of the house. And I say that because that helps you to get comfortable that our supply chain is absolutely global today. The components that go in those devices today are not made in the US, so we have a global supply chain, and that potentially some of the tariffs, as they become clearer, that might trigger some changes and shifts in our global supply chain from country to country, but those components cannot be procured in the US today. There is very limited final assembly done by us for those devices. And for us specifically, that means that is done for us in a facility we own and operate, because we believe in that in Mexico, where we have very limited, as I said, value add. So you can, like everyone else in the US, every day we play what is the best sourcing and what is the best manufacturing setup, and we feel quite comfortable that the way we understand it today, our manufacturing footprint remains, and our sourcing might move around a bit. And certainly the one element that is in cast in stone as of today, any type of tariffs from China, there is no sourcing for our product that goes into our product from China. So the one element that is cast in stone today has absolutely zero impact. And then more importantly than on the supply chain and sourcing side is that, like everyone in the industry, is how do I get my customers to compensate me?
Thank you, Peter. Appreciate you joining us virtually today. Congrats on the first 100 days and good luck in the next year or two running Landis. Welcome on board.
Thank you so much. Appreciate, and thank you for your interest.
This podcast is an excerpt from Gabelli Fund's 35th Annual Pump, Valve and Water Systems Symposium. GAMCO is providing these links as a matter of general information. We do not intend for these links to be a complete description of any security or company, nor is it a research report with respect to any of the companies mentioned herein. As of December 31st, 2024, affiliates of GAMCO Investors Incorporated beneficially owned 5.1% of Gorman Rep, 3.3% of Graham Corp, 2.65% of Enpro, 2.44% of Watts Water Technologies, 2.41% of Mueller Water Products, 2.05% of Flowserve Corporation, and less than 1% of all other companies mentioned. One of our affiliates serves as an investment advisor to Crane Company or an affiliated entity and has received compensation within the past 12 months for these non-investment banking securities-related services. The analyst's views are subject to change at any time based on market and other conditions. The information in this posting represents the opinions of the analyst and is not intended to be a forecast of future events, a guarantee of future results, or investment advice. Views expressed are those of the analyst and may differ from those of other GAMCO officers, analysts, other employees, or the firm as a whole. Because the investment personnel at GAMCO and our affiliates make individual investment decisions with respect to the client accounts that they manage, these accounts may have transactions inconsistent with the information contained in this posting. Certain GAMCO personnel may know the substance of the posting prior to its posting. This webcast is not an offer to sell any security, nor is it a solicitation of an offer to buy any security. Stocks are subject to market, economic, and business risks that cause their prices to fluctuate. When you sell shares, they may be worth less than what you paid for them. For more information, a prospectus, or summary prospectus, visit our website at www.gabelli.com or call 800-GABELLI or 800-422-3554-914, 921-5100 fax, 914-921-5118 info@gabelli.com.